Okay, here we are to episode 5 of Extra Credits History of Paper Money. We are still dealing with the moral quandary of why is Extra Credits pimping paper and electronic currency systems controlled by governments and the warfare state. Based on that, based on what they have said in the first episode, that paper money is good and gold is bad in a material sense, that they have created this problem all the way through the episodes going forward. If you haven't watched the previous episodes, go back and watch the previous episodes. We're getting the full uh, full audio and video of theirs with my overlaid commentary on them, and I will lay out where they have gone wrong, and we're going to go ahead and jump into this one.
Episodes, we've seen the intellectual underpinnings of paper money slowly come into place. But having nebulous ideas about why paper money might be good is one thing. Getting people to really believe and trust in it is another matter entirely. And so today, we're going to tackle the development of the one thing that brought the whole system together. The thing we now use to prevent the very problem John Law ran himself into.
This is great. I'm gonna love this. They have the solution that we've been looking for the last 3 episodes.
Very rarely does humanity find ideas that are simply good. Most of the time, when a revolutionary new idea is introduced, we've got to stumble around in the dark for a bit, figuring out all the terrible ramifications and pitfalls that come with it before we can use it well.
I'm pretty sure that's still the case with this. Let's see what you say.
Paper money was no different, because when you start printing money, it comes with a lot of questions. Now, you might think that the first question would be, how much money should we print? But actually, before you can even figure out things like how to regulate how much money's being printed, you first have to ask, who's gonna print the money? Now today, this might seem like a bizarre question, as we're all used to there being some central authority in each country or currency block issuing one currency that everybody accepts at face value. But you have to remember that paper money didn't enter the world as part of some top-down system. Instead, it basically started with a bunch of bankers realizing that they could give people receipts for gold and silver instead of actually giving customers their gold and silver back. Which means that one by one, every bank basically started printing their own banknotes. And that is a mess to deal with.
Well, are you going to lay out how it's a mess to deal with? Because it's only a mess to deal with if these obligations don't line up, right? It's not that, oh, there's a lot of private people that are doing business and that's messy. No, that's not really the problem. The problem is if this does not match this, if this does not match this, if this does not match this. So it's just as bad when you have a corrupt government doing fraud and lying with paper currency as it is with private companies doing it.
I mean, if you've ever had to go overseas and deal with exchanging money, you have gotten just a tiny fraction of an idea of what a hassle this would have been. But it gets worse. Imagine having a few hundred different banks issuing notes in your own country.
Again, this just seems to be a straw man that they're building up, because didn't they just say in the previous episode that they had all these private banks, and if you had, they were so widely recognizable that if, say, this bank got a note from this bank, they were in communication with each other. So if you came into light blue bank with yellow bank's notes, they'd be like, yeah, we do business with yellow bank all the time. I'll take that for a small fee and I'll go over here and I'll get my money from them later. They laid out exactly how that worked in the previous episode. So this just seems like a straw man that they're creating to make this system into something bad so they can prop up this centralized system as something good. Let's go and see what they say.
Now imagine a world where our modern international currency exchange that makes it easy for banks to trade money doesn't exist. And then imagine having to deal with all of this just to shop in the next town over.
And hang on, guys, you just said that it wasn't a big deal.
And then national currency exchange that makes it easy.
I mean, I wanted to find a picture, but let's see.
Country.
Yeah, you just said whatever. you just said that the notes were recognizable, that they were interchangeable, and that people understood them, and it was the system that was in place. So you're contradicting yourself, and you're making a straw man here. Let's keep going.
Money doesn't exist. And then imagine having to deal with all of this just to shop in the next town over. This is basically the scenario you end up with. You deposit $10 worth of gold in your local village bank. They hand you back $10 worth of their shiny, bank-specific banknotes. Now you go off to the big city to spend your money, but when you bring out your money to spend it on something there, the big city merchant might simply not take it. Or, more likely, they'll pull out some big chart and say to you, well, let's see. Your bank is pretty far away, so if we, or more likely our bank, ever wanted to redeem these banknotes of yours, we'd have to travel all the way to your tiny podunk village.
Contradictory, right? You just said that this wasn't a problem, that we had bank branches. Now you're taking something that you minimized as a problem in the previous system, and now you're maximizing it. And then on the other hand, if these were such a hassle, and these were so useless, why wouldn't she have just kept the widely recognized, accepted for 6,000 years as valuable across cultures, much less across little towns? In this case, she would have just kept the gold and silver, right? You wouldn't have had this problem at all. So I'm just not very impressed by this argument so far. Let's keep going.
So, since that's going to be such an expensive hassle for us to do, we are only going to take your banknotes at 75% value. Now, of course, you would probably grumble a bit over this, but then the merchant would say, wait, hang on, I'm not done. It says here that your bank only has one branch? That's an issue. It means we're gonna have to redeem these notes as soon as possible because your tiny bank might go belly up at any time, which would render these banknotes you just gave me worthless. That additional risk and the inconvenience forces me to accept these bills at another 25% off face value. And so, your $10 that you deposited in your bank would only have $5 worth of purchasing power in an...
This system would literally never exist because you would just keep the gold instead of making the exchange in the first place. So basically, yes, there are bad banks. Yes, there are banks that have done stupid stuff and issued too many notes and gotten themselves to the point that people will only accept their notes at a fraction of the value. But it's because the bank has done something stupid to cause that. It wasn't because of the distance between them, or it wasn't because the number of and they might make that argument. Somebody might try to con you that way and argue that. But really, if you get this kind of disparity where a bank's notes are trading at half their face value, it's not because of the cost of transactions or distance. It's because the bank has engaged in some sort of risky or fraudulent behavior in order to make their banknotes less valuable than face value. Let's continue.
Neighboring city, leaving you probably a bit less than jazzed about this whole paper money thing. So clearly, every country needed a unified currency that everyone could believe in. But this also had to evolve sort of organically, and it ended up happening in a similar way in most countries, because almost all of the problems we're gonna see with the move to paper money are solved in nearly every country with one great innovation: the central bank. But central banks didn't always solve all of the functions they do today, and in fact, most weren't established to solve any of them at all. Truth is, calling a central bank a singular big innovation would be a lie. They were really more like a patch server and a hotfix machine for paper money. So let's talk about the story of the Bank of England, because it was really the first institution that we would call a central bank, and many early central banks share a similar tale. The year is 1694. The government desperately needs a way to service its debts.
Okay. And as implied by the smoldering little image here that they had, I wish I could find these.
1694. The government...
There's the smoldering image of the government debt, and see how they've got it all bandaged up and beat up? Maybe it's because they were funding a war. An illegitimate war of imperial conquest, perhaps? Why would I want more of those? Maybe I would want this like horrible unpaid debt to stop the war. Let's keep going.
Government desperately needs a way to service its debts. The 17th and the 18th centuries would be times of unbelievably costly wars. For the first time, troops had to be deployed and supplied across the globe. Navies had to be maintained in every ocean. Powder and shells were expended on an unprecedented scale. This drove most major nations of Europe to the brink of financial collapse. To some, the answer was clear: establish a bank to service the national debt. So, after much debate, the Bank of England came to be. This is a powerful thing, because having the government do all of its banking with your bank makes your bank pretty secure, and means that that bank's gonna need to have branches, or at least banks that they work closely with all over the place. And because of this security, people started to value Bank of England banknotes over most of the other ones out there. At times, people would even pay a premium for them, offering 1.1 or 1.2 pounds per £1 note, simply because they were reliable and universally accepted. But the Bank of England note really wouldn't become the official banknote of the country until 1844, the middle of the 19th century. With the Bank Charter Act of 1844, no new bank would be granted the right to print banknotes, and every time a bank was bought, it would have to remove its notes from circulation, meaning that eventually the Bank of England banknote would be the only paper money in the land.
Okay, so what the process we're being described here is a process of centralization. And centralization is only as good as its outcome. Okay, so if by centralizing my outcome, I get a good result, then centralization is good. If I centralize and I create this authority that only magnifies the problems rather than solves the problems, then it's not good. It's like fire. I mean, fire can keep you warm, it can cook you breakfast, and it can burn your house down. So this whole process of centralization here is neither good or bad, and we have to see what the outcome of that centralization is.
But even with this system, it wasn't until 1921, less than 100 years ago, that the last non-Bank of England bank in the country stopped printing their own banknotes. And in Scotland and Ireland, there are still to this day a few banks that retain their ancient right to print pound sterling notes. So this system of having one unified currency that we think of as being money, we take it for granted now, but it...
Well, come on guys. Gold and silver were the unified currency before, right? Right? It's not anything new.
Really isn't that old. In fact, in the United States, non-Federal Reserve banknotes were being issued as late as 1935. But even with this issue resolved, the lack of a centralized currency wasn't the only problem we were going to have to figure out with the...
Wait, lack of centralized currency? Again, a lack of a centralized currency is not necessarily bad. It's only if this can actually produce something better than this.
These new banknotes. There was also the problem of bank runs. With the invention of the banknote, modern fractional reserve banking really came into its own. Fractional reserve banking is where the bank lends out more than it can actually pay for with the money it has on hand.
Which is fraud.
Based on the idea that not everybody's going to try to collect at once.
Which means you're lying to a bunch of people that they can collect anytime they want.
So, for example, let's say that you deposit $100 in gold at your bank, and the bank is required to keep a 10% fractional reserve. That means that when you deposited that $100 in gold, you enabled your bank to lend out an additional $1,000 in banknotes. This system is a great thing because it...
Why? Why is it a great thing? Because we just caused massive inflation?
Means that the money supply can expand far past the amount of gold or silver in an economy, and can meet the needs of a growing economic base.
Again, I've already laid out in the previous that this whole notion that the supply of money needs to grow in order to allow for new production is just complete BS. Basically, if you had a situation where we desperately needed to bring on new production of something, then what you would have is a demand for gold and silver to fund the initial investment, right? So that would increase the value of gold and silver, which would incentivize people to save money and invest because you would have an increase in interest rates. Basically, we had a balanced system before. We had a balanced system that would take care of the needs of an actual growing economy. What we didn't have is a government middleman getting rich playing in the middle between the gold and silver and the actual productive economy.
Which is the very problem we were trying to solve with this whole paper money thing in the first place. But it does have
Not really a problem.
one problem. What happens if everybody does try to get their money out of the bank at the same time?
Tell us, Extra Credits, tell us.
Well, if people believe that a bank won't be able to repay them, whether it's because they've issued too many banknotes or simply because they've made too many bad loans, those people start flocking to the bank to get their money out of there. This, of course, leaves the bank unable to pay anybody because they only keep a fraction of what they need to pay everyone on hand at any given time. So the bank collapses, and everybody loses. Anyone with money left in the bank is simply wiped out. And if this starts happening on a broad scale, it creates another problem. People stop depositing money in banks at all, and instead start hoarding it because they're afraid that the banks are going to go bust. Meanwhile, the banks are trying to hoard up as much real money, gold, silver, and central bank notes as they can, so that they can somehow pay all of the people rushing the bank to withdraw their accounts without going bust. This ultimately means that a lot of money is just sucked out of the economy. It just stops circulating, and we're back to our original problem of literally having too little money to make the economy run.
This is the misnomer that deflation is the process that he just described. The velocity of money decreases, which reduces the availability of money, which makes money more valuable, which means it can purchase more goods and services, which at that point, it's basically prices are coming down. And when prices come down, that means your standard of living is actually improving. So basically, inflation is only good if you're in debt, and deflation is good if you have money. And these are naturally balancing situations. So what would happen in Extra Credit's little scenario here is everybody is desperate to get a hold of money, right? So they're willing to take lower prices. They're willing to take less money for the same amount of work in order to, get a hold of this money, which is now considered more valuable than it was in the previous scenario, where the gold and silver was more prevalent. And what happens is those lower prices entice people to buy stuff. It rebalances the supply and demand, the basic economics 101 supply and demand scenario. So this whole process is attempting to solve a problem that is only really a problem if you're a debtor. If you're a debtor, this is a horrible problem for you because now the debt that says you owe me 100 gold coins. And if getting gold coins suddenly gets harder for me, then that's a really big issue because now I have to maybe work twice as hard to get those 100 gold coins, right? But on the other side of that equation, if I was a guy who saved 100 gold coins and then all of a sudden there's a deflation, well then that means my gold coins are worth twice as much as they used to be. That means I can go out and buy twice as much stuff if I feel like it. So they're presenting this as this horrible, horrible problem. And the only theory I really have at this point is because governments are the debtors, and the governments also have arbitrary authority over the people. They are looking at this problem with blinders on because the government is in debt and inflation is good for debtors. They want inflation, and because the government is in debt and deflation is bad for debtors, they also don't want deflation. So we're taking a scenario that has no moral value, that basically is already balanced, because what is bad for debtors is good for savers, and it balances out in the economy, and supply and demand meet, and it's already balanced. And then we're shifting it, and we're shifting it to the view of governments, to the view of debtors, to the view of war spenders. And we're looking at this problem as like, yeah, this scenario that they just outlined is a really big problem if you're a gluttonous state that goes on wasteful war expenditures. But it's not really a problem if you're an average Joe that doesn't go too deeply into debt. Let's keep going.
This happened in England throughout the 19th century. But here again, the central bank patch was applied. By having a central bank serve as a lender of last resort, meaning a bank that could lend real capital to other banks, banks that were in good shape but didn't have the funds on hand to withstand a panic where everybody tried to withdraw their money at once, could survive, and the money supply for the nation wouldn't dry up.
So you only really have this problem if you have a fractional reserve system, and there's really no reason why
Supply for the nation.
There's really no reason why this has to be done by a central bank. If you are a small bank and you have a problem, and there's a bigger bank and they don't have a problem, and this is just a perceived problem, like you said, and you're actually in good shape, then there's no reason why this bigger one couldn't do the same thing if it was a private entity. The only reason they're assuming that you can never get an end run here. And an end run is the thing that the people are doing right here to this small bank, the people can do to the big bank. It can happen maybe not just as easily, but it can happen. Here you have what is called a bank failure. Here you have what is called a currency failure. And to suggest that you've solved the problem is actually false. What you've done is taken a bunch of smaller issues, and I'm just going to compare this to, this is the 2008 problem. This is people making, say, bad housing loans. This is people making, the housing crash or the dot-com bubble, right? This is that problem right there. It's corporations, it's banks, it's mortgage lenders making bad personal decisions. And you have good ones in here and you have bad ones in here. And they're right that the good and the bad both get punished when a market crisis hits. What they aren't saying here is that if you have a central bank just print up a bunch of money to try to solve this problem, all you've done is move the problem from here to here. And then all you've done is created more time until these people, instead of ending up at this door, end up at this door. And you have a collapse of the currency. Let's keep going.
Wouldn't dry up. Over the last 100 years, we have found dozens of other little ways that the central bank can be used to hotfix problems resulting from our ability to print money. And we're certainly not done yet. There is incredible power in having one bank that basically can't fail unless the government does.
Okay, but this has no moral content, okay? This has no moral content. So if the government survives by defrauding the people, it is not a good thing. Let's keep going. The government deserves to, if the government defrauds the people, it deserves to be punished for that. And if it can escape punishment, then that's a bad thing.
Function is much more about keeping an economy strong and stable than about making a profit. Because so long as the government is doing well, so is that central bank. And this has helped fuel the growth of a world no longer bound by the amount of gold and silver that's being passed around.
This is just a false narrative. I've already covered it. Let's keep going.
But there's one more step to go before we get to the world we live in today, where currency is divorced from any real value except the value we give it. Where money works because we believe it works. And that step is abandoning the gold standard. So join us next time as we wrap up the history of paper money.
Okay, I'll see you guys for their episode 6. Bye.